are live.
Let me make it sound so that I have the echoing.
All right. Good good afternoon, everyone. As I was saying earlier, that I was expecting that we have assignments that we should have done by now. The assignments from the last live class that we had, and then the assignment from the recorded class. So I expected that by now we've done the assignment. For those of us that have not attempted the assignment, let's do well to run through it and to run through the class itself, listen and pay attention to the class itself, and then do the assignment. All right. Then, while that is said, I will just go straight into the class now.
What's in this life? Yes, it's life.
Yes. All right. So last class we talked about three forms of analysis, and we saw technical analysis, we saw the sentimental analysis, and we talked about the fundamental analysis. And then I remember that I made mention of the fact that when we are talking about fundamental analysis, we it is trying to analyze the market using real time events. All right, using real time events. Basically, by real time events, obviously will be received, or the way you can keep track of that is through news. You get, so the way you can keep track of real time events is through national news and stuff like that. So and that's what fundamental analysis is in its very basic sense, just trading the financial market, trading the financial market using, employing the use of news and whatnot. So we'll be talking. I introduced a little bit of technical analysis last time, and then we're going to take it a little bit further um, today in this class. So technical analysis. When we talk about technical analysis, what are we talking about? When we talk about technical analysis, what are we talking about? All right. So technical analysis basically, as I said, I remember that I said last week that it is using the past to speculate the future. As you can see on your screen now, it says technical analysis is the study of past price activity in order to forecast the future price direction. It is the study of historical price movement. And remember that history has a way of repeating itself. I think I mentioned this the last class also, that if there is any statement that you can say technical analysis is built upon, it is the statement history has a way of repeating itself. That is the singular statement that technical analysis is built on. History has a way of repeating itself. So history will always repeat itself. History will always repeat itself. So it means, and that is why there's a reason I am emphasizing on that, so that you can see that in technical analysis, the study of the past is very important. Is super important. So we study the past to predict, to forecast the future price direction. So we study the past price activity to forecast the future price direction. Did you get? So it's a study of historical price movement. So basically, that is what technical analysis is in its simplest form. In its simplest form, that is what it is. All right. So in technical analysis, now if you go back to the chart now, so that going back to the 19th century, this is the father of technical analysis, Charles Dow, observed that it is the direction of peaks and troughs that defines the trend of the market. It is the direction of peaks and troughs the trend of the market. That is, we saw that earlier. The peaks and troughs simply refers to highs and lows. All right. So it is the direction of highs and lows that reveal future price movement. All right. It is that direction that reveals future price. So it means that you pay attention, and just like it's just like a tangent from what we saw earlier about the uptrend and the downtrend, that we are able to know that the market is in an uptrend because of the way the highs and lows, the way the market is forming the highs and low, where the market is forming the highs and low. So it's just to further back up what the part of the technical analysis just though said here, that it is the direction of peaks and of troughs that defines the trend of the market. In other words, by saying peaks and troughs, you're referring to the direction of highs and lows. The direction of highs and lows. So moving on from there, and you can see this typification just like as a quick revision for you now on as a quick revision for you on on market movements that we clearly saw earlier. You can see higher, you can see I, and you can see the HH there. I think I drew that for you on the board in the last recorded class. If you paid attention, see this I, you can see the higher high, you can see the higher low, higher high, you can see the higher high, higher low, higher low, and all that. So you can basically see that in the market to form your uptrend, obviously, and you can see the lower highs and lower lows. All right, to form your downtrend, and you can see the other high equal high, low equal low. All right, you can see that in your ranging market, All right, so moving on from there, we'll be coming back to this very soon. We'll be coming back to this very soon. But then let's check this. It says that thus when the market experiences two peaks and two troughs successively higher than each other, then the market is said to be in an uptrend. We saw this earlier. That when the market just, and you can see you can see the you can see the supporting diagram. You can see the supporting diagram just by the side. You can see the supporting diagram just by the side, that when the market is experiencing two peaks and troughs successively higher than each other, the market is said to be in an uptrend. So then the opposite is true as well for a downtrend. The market is showing two peaks and two troughs successively lower than each other. So the market is said to be in a downtrend. All right. So read that it says the work of Charles H. Dow and his partner Edward Jones. So it shows that the trend remains in effect until clear reversal occurs. So the trend remains in effect until clear reversal occurs. And this was going to lead us to talk about, trend reversal and retracement. All right. We're going to talk about the difference between reversal and retracement. So we are just going to like back up a little bit. Just going to back up a little bit. Right, so it says here that a reversal is defined as price turning point to the opposite direction of the previous trend. So a reversal is defined as price turning point to the opposite direction of the previous trend, while a retracement is defined as a price pullback in a trend. So it means that a reversal is a trend reversal. It means that it signifies the end of a trend, while a retracement does not signify the end of a trend. Now, what does that mean? It means that the market is forming a series of higher highs and higher lows. All right. So if the market is forming series of higher highs and higher lows, if that is happening now for a reversal the market stops forming that. It is forming higher highs, higher lows. So it means that the market is in an uptrend. So when you have a trend reversal, it stops forming that and then it starts forming the opposite of that. It means that the trend is changing direction. The trend is changing direction. All right. So, however, a retracement is what you can call a pullback. It is not a change in the market direction, rather, it is a pullback. All right, is a pullback. So the market is going, that point, for example, take a good example of the uptrend, for example. Now, the market makes an high, comes back down to make a low, then goes up, makes an higher high, all right, and then come back down, makes a higher low. Now, what that simply means is that every single time the market is coming back down to make a low, to make a higher low, it is called retracement or pullback. Do you get? So it is still within the trend. So and that's why that statement is very important. That a retracement does not signify a change in the larger trend. It does not signify a change in the trend of the market, not necessarily. However, when you talk about a reversal signifies the end of a particular trade. A reversal signifies the end of a particular trade. So that is what a reversal signifies. And that's the difference between them. That a retracement, you can have retracement while the trend is going on. All right. While the trend is going on. Whereas when you are having a reversal, it is usually at the end of the trend. It's usually at the end of the trend. So I believe you understand those two words basically. They are not uh, rocket science. So I want to come back to this. It says how to trade trending market. So you can see the EMA, the ADX. Say a little bit. I introduced us to support and resistance in the class, in the last class actually. For those of us that paid attention and followed the class, I introduced us to support and resistance. And I will just try to like read what you have on your screen. Now it says they are likened to floors and ceilings. I remember that I used this particular analogy. There's price floor and price ceiling in the market. They are price areas that tend to act as barriers. Top end zones, which the market has difficulty breaking through, are known as resistance levels. Bottom end zones, where the market has difficulty breaking through, are known as support levels. Note, these are zones, not lines. View them as temporary floors and ceilings. So and I think at this point, when you are done, if you understand what I just said, you should also, even if you don't understand it, you also make a very good reference to the last class we had. The last class, you should go and watch the last class, because I made a very good example of this where I was drawing it out. It was first a line, and I was saying that support and resistance are not meant to be treated as lines, they are meant to be treated as zones. Now, different price can now fall into that zone. All right. So your support and your resistance holds true. As I said now, that you should treat your support and resistance as, and the thing is that if you look at how support and resistance is created, it is we basically trying to give credence to history. It is we trying to say that, okay, the price bounced back at this level one time. Because it has bounced back at this level before, there is a chance that it is going to bounce back at that level again. All right. So basically, that is what it is. It is, and that is why it is a tool in technical analysis. I mean, support and resistance now. It is a tool in technical analysis. Don't forget how I explained in the class. All right. So you have your, the ceiling, the top. That is a resistance. It resists. So the price is going up. It hits the resistance, and it resists the price back down. All right. Then you have your support. Okay, you have your support, price is coming from up, all right, hit the support, and the support supports, the price back up. Do you get? So basically, in a very simple way, I don't think it gets simpler than that. All right, that is what support and resistance is. That is what support and resistance is. And then there is a way to use these tools. When trading, there is a way to use it for you in a way. It makes you it gives you the opportunity to know the key levels in the market. All right, it gives you the opportunity to be able to identify the key zones in the market. So if you can identify the key zones in the market, it means that you can anticipate activity at those areas. You can anticipate activities at those areas. You can know that, okay, market is going to do something. Now, one of the last points there said that you should treat these zones as temporary floor and ceilings. Now, focus on the word temporary there. Now, why temporary? Temporary because a support is always not going to be a support. You get? If a support is there and it is just always a support, what that means is that price have not broken through that particular support before. All right, price has not broken through that particular support before. Now, the moment price breaks through, now don't forget, for a support now, the price is coming from up. All right, and then it hits support. Now, if it hits support and rather than bounce back up, the price keeps going down. What that means is that price has successfully broken that support. Now, it has turned that support into a resistance. Now, what do I mean by that? If price break down underneath the level, all right, of that support, and price is now trying to come back up, what used to be a one-time support is now a resistance to price. Did you get? So in the same way, supports can be broken to become resistance. Resistance can also be broken to become support. All right. Resistance can also be broken to become support. Okay. So I believe that's self. I believe that's clear. I believe that's clear enough. And let's pay attention to this. Let's pay attention to this image on our screen. Now you can see that you note this particular image, you see that it calls it at the supply zone and the demand zone. So we have the supply zone and the demand zone. As you can see, that it is not a single line. Please, it is very important that you note that it is not a single it is a zone. It is not just a price. Why is that? Is because different prices can be within that zone. All right, different prices can be within that zone. And one of the things that this knowing this is is very key to what is that it helps you to be able to make to make right trading decisions. All right, so that you can estimate things properly. You can estimate things properly. All right. So basically, that's the thing. There was something I said earlier that I would want to like reiterate again and say it again. It is that when we say we want to use support and resistance, it is a lesson in history. It is a lesson in history repeating itself. That is, we are saying that price reacted so and so and so and so and so day when it got to this level. So now we are approaching that level again. I am watching out for what price will do. Will price just ignore the level as if it does not exist and move on, or will price honor it? Do you get what I'm trying to say now? So it means that when we are in looking at support and resistance, it is just like that's why it is a tool in technical analysis. One of the ways we use history to forecast, all right, the future price direction. It's one of the ways we use history to forecast the future price direction. I believe that's clear enough. Now you can look at this on your screen too. You can see the resistance now. You can see the resistance and you can see the support. So you can see the zone up there for the resistance. And look at if you look at those blue arrows, if you look at the blue and the red arrow came to touch that zone about 5 different times. So price came to touch the resistance zone 5 times and it touched the support zone 4. All right, and it touched the support zone 4 times. Now, this means that the general way where in which you can alongside other trading tools, alongside other other what's it called trading, other trading rules that you have. One major way that you can trade in this kind of market. Now don't forget what we called this kind of market. We said this kind of market is the ranging market. If you remember, the market is moving between a fixed level. Market is moving between a fixed price, a fixed level. Now this means that when we look at when we look at this closely now, you see that if somebody that wants to trade this market now, you have to buy or be looking for opportunities to buy at support and opportunities to sell at resistance. For example, now, if you look at this particular line, the third by the moment it forms price the first price movement, it creates the resistance, comes back down, goes back up again, retests that level and then come back down. The moment two of those levels are locked in, that is the first two arrows. You can draw your either your small rectangle or whatever works for you, but just forget that it is not a line. So you can draw, your resistance there that, okay, I am looking at this zone. So price is doing whatever it wants. So when price is approaching that zone again, you are watchful, you are alert that, okay, will price still respect this zone or just dash away? Did you get? So if price is still going to, if price is still going to, going to stay and respect that particular zone, it means that you can expect that what happened before would happen again. Oh, price went down when it touched this zone. It has happened 3 times. Oh, what are the chances of it happening the fourth time? And that is what trading is all about. Remember that when we said earlier, that when we started the class, I told you that really largely it's about making informed decisions. That trading is about making informed decisions. It's about making informed decisions, at good times. All right. So look at the fourth one now. The fourth blue arrow. Look at the fourth blue arrow. As at this time, the price have retested that support level and went back to meet the resistance. Now, this fourth time, it was not going to be any different. It touched it up and it went back up. All right. So we have to understand that. And it's just like what I was saying earlier, that really when we when we talk about support and resistance, it is a technical tool. We are basically looking at what market has done in the past, and we are using that data to to predict what market we do now and in the future. So we are using that data to predict what market will do now and in the future. So you can see the terminology consolidation on your screen. So you can see terminology consolidation on your screen. So when basically consolidation refers to when market is ranging. So you say it is consolidating. That is, it is not picking a direction to go. It has not moved. The market has not moved in a particular direction. So you said the market is consolidating. Did you get that? You said the market is consolidating. Since the market is consolidating, that's basically what consolidating means. Now I'm going to need you guys to pay good attention here. I'm going to need you to pay good attention. Now, this is like a good diagram typifying support and resistance. And I want you to note, pay attention to the lines that were drawn on this diagram. Now, at the base of this line, you will notice that from the left hand side to the middle, the market has been forming lower highs and lower low, which according to, as I taught you, that is a signification of what, of a downtrend. So the market has been forming lower highs and lower lows, lower highs and lower lows. Now you will notice that at the very base of this particular chart image, those two things that at the base that look like W, can you see it? We call it that's that we call it double bottom. Is a chart pattern and all that. So if you look at if you look at that thing that looks like a W, now you will notice that it was at that point that market failed to make a lower low. So because at that point the market fails to make a lower low, as we said earlier, if market now goes ahead to make a higher high and the higher low, it means that market has shown you clearly, all right, market has shown you clearly that a trend reversal has happened. It has shown you clearly that a trend reversal has happened. So a trend reversal has happened. So, and now you are going to notice something. I like this particular diagram. It can help illustrate these things. Now, you will notice that even when the market was selling, before you got to the point where the trend reversal happened, you would notice that the market kept pulling back. All right, the market kept pulling back. It means that the market does not just move like a slingshot that you just throw it and it just keeps going bam, till it gets to its destination. Not necessarily. As we saw earlier, the market moves, obeying certain things that are happening in the market and responding to them. Now, you will notice that it will form a lower low and go back up. All right, it forms a lower low and then it goes back up. Now, when it forms a lower low and it goes back up, one might want to get confused, or you shouldn't. All right, and it is going back up. Now, that movement back up, all right, is what is called retracement. That is the pullback. Do you get? That is the pullback. What you can also call the correctional move. The impulsive move is that the market is in a downtrend. It is steady. Do you get? And when you start buying too, in this same image that you can see on your screen, you will notice that it kept cutting back. It didn't just keep going up straight, bang, 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 not necessary. No. So the first thing to do was that, he, when you look at the market coming up like that, comes back down, that action of coming back down, as I said earlier, it is the retracement. Now, note that it is not a trend reversal because it did not signify, all right, it did not signify a change in the trend of the market. So, as we said earlier, that it is a reversal that affects the price direction. However, a retracement does not. A retracement does not. Now, you will notice something that, um, look at from the right hand side of the diagram on your screen. You would see from where the uptrend started that each time a new resistance is created and there's a little pullback, the little pullback, goes back up and break that resistance. So it's like an endless journey of resistances being broken. Do you get? So it comes back and break that resistance, forms another higher high, a pullback again, all right, goes back up again. Do you get that? So it means that basically when you talk about support and resistance as we know it, it is the very fabric in your chart. You cannot afford not to understand this. You can't. You can't afford not to understand this. You can't. So support and resistance is that vital to the way we trade. And just as I told you earlier, that when you are trading, with support and resistance, just like we said earlier, that when you are in an uptrend, you look for opportunities to buy. When you are in a downtrend, you look for opportunities to sell. So likewise, when you are in and we saw that when you are in a ranging market, I think I talked about that earlier today, that when you're in a ranging market, what happens is that at the support, at the base, you look for opportunities to buy, and then at the resistance, that's at the ceiling, you look for opportunities to sell. All right. So that's, you use that, coupled with, alongside, other trading rules that you might have. So once again, support and resistance levels are what we call, pivot levels. They are important levels as defined as price zones where direction of price movements can possibly change. And I mentioned this earlier, that they are high activity zone. Something will shall happen. Do you get? Either there's a high liquidity that is happening, that happens immediately there, where something, at the support and resistance level, price just breaks a support. Or now, if price breaks a support and turns the support into resistance, how we price it that it is price that is coming, all right, from up, breaks the support down. Do you get? Now, if that happens now, that is an activity. All right, that is a support and resistance breakout. All right, he has broken out of that level. Okay, it can happen like that too for downtrend. It can happen like that too for resistance. It can happen like that too for resistance, where the price is going up, it breaks a resistance up and turns that resistance into a support. So you can, in other words, you can call support and resistance hot zones. They are activity zones in the market. Now, another reason why they are activity zones in the market is that you are not the only one that is looking at them. All of us, a number of traders in the world are looking at those same key levels. Is that okay? A number of traders in the world are looking at those same key levels. And sometimes this is what affects what actually happens in the market with those key levels, because a number of traders in the market are using those key levels to make trading decisions. So a number of traders in the market are using those key levels to make trading decisions. So imagine now price is approaching a particular support. So price is approaching a particular support now, and people are like, okay, when it gets to that support, we are going to buy. We are going to buy. Now, there are times that because of that, people have set pending orders. Pending orders are in those levels already. So price will just get there and just move in a crazy way. You'll be wondering what's happening. Well, they are the work of others. They are pumping the price. All right. So it means that because you are not the only one that is looking, and that is why you must know how and you must know where to actually, to actually practice, or to actually what's the word now, to actually use these things. Do you get? So you must know what and where to actually use this particular thing. So you are trading now and price breaks forth. That is an activity zone. People have placed orders there. So you just imagine that it breaks forth and then the candlestick that forms, very bold candlestick, it moved a lot. Do you get? So that's another reason why support and resistance are important. You are not the only one that is looking at it in the world. There's a chance that most of other traders are also looking at those same zones and those same levels, to enter the market. Now, the onus is on you as a retail trader that you place a trade that is in favor of what the general bias is doing, because it is the money that moves the market. It is the money that moves the market. It is the money that moves the market. Okay. All right. So this second point is that professional and profitable traders use support and resistance level to identify areas where buy or sell pressure exists. Do you get that? Where buy or sell pressure exists. And another thing that you also use support and resistance to do is you also use it to determine your stop loss and your take profit. For example, you are buying a particular currency pair, you are buying it, or a particular commodity for that matter, you are buying it, and after a while, all right, after a while, the price keeps moving up in your favor. Then suddenly you check your chart and you see a support that you've not seen before. That price is about to approach that support. Based on on the way that price is moving, you can now tell that, okay, this support, there is a chance that the support holds and price comes back down. If that happens, I might lose some money. I might lose some profit that I have made. Now, there's another chance of price breaking through and continuing. Do you get? If that way, if I am in the trade still continues. Do you understand what I'm trying to say? So it means, therefore, that you can also use support and resistance to determine your exit in the market. Not only can it help you to determine your entry, but it can also help you determine your exit in the market. Because if 70 to 75% of the world traders are looking at a particular level as a place they want to exit, if you hold that trade too much and you are not exiting with them, there is a high chance that you are going to suffer it. So support and resistance are that important, to the trading. They are that important in you understanding the chart and in you trading on it. Now, this last point says support and resistance level are especially useful to short-term and intraday traders who are looking to take advantage of small price movements in a short term. Now, I should also say this, that support and resistance works on every time frame. Whether your chart is in 1 hour, 30 minutes, 15 minutes, your support and resistance works across, all right, all time frames. Now, of course, the support and resistance that you draw on a higher time frame is much more stronger and holds far more a weight than the support and resistance that you draw on lower time frames. However, whether on small or higher, it holds a weight in the mind of the hearer. It holds a weight, all right, it holds a good weight in you determining what to do and what not to do, your entry, your exits in the market. It is very important that you understand this. It is very important that you understand this and all that. So we saw, okay. um, so next we are going to be going through how to okay, I think here is found it. So we are going to be going through how to actually trade, trending markets. We're going to be going through how to actually trade trending market. And we're going to be looking at a few indicators. We're looking at the EMA, the exponential moving average, and we're going to look at the average directional moving index. That's the ADX, and I'm going to like walk you guys through setting it up. All right, so I'm going to walk you guys through setting it up, and we are going to see how we take it from there. So I'm going to walk you through how to use your EMA to trade, how to use your ADX to trade, and then after that, I'm going to walk you on how to accurately interpret your trade signals. If I'm saying do this, do this, do this, like when you see a signal, what are they telling you to do exactly? So I'm going to look at terminologies, all right? Like if I'm saying that break even, trail your stop loss, trail the stop loss, break even, we're looking at those terminologies. What do they mean to somebody that is trading actively? And as I said at the end of this class, I'm going to repeat that again. That we have basically three goals for this class, which is number one, to give you a very good foundation with which you can build your forex trading journey on. Number two is to ensure that you can, accurately interpret and effectively. Number three is to ensure that you are making money as soon as possible. And that was why I admonished you guys that as soon as trading started, that you got, you sourced for your money to like, to fund your account. Do you get? So that you can be able to take advantage of the free signals that we have been dropping, for a while now. So basically, that is what it is. So, and I need you guys to pay attention to that. That is what we are looking to achieve in this training, particularly. Right. So, in the next class now, I'm going to be talking about moving average. I'm going to be talking about exponential moving average and EDX and how you can use them to trade a trending market. All right. So that will be the end of the class for today. Thank you very much for your time. Let's ensure that we go through. And those of us that have assignments that we've not submitted, let's ensure that we do that. Shalom.